This is $1.25. In the 1960s, that was the federal minimum wage for an hour of hard labor. It sounds almost cartoonish now, $1.25, a number so small, it barely registers as money in the modern economy. But pause for a second. Look at what is actually sitting in your hand. It isn't just change. It isn't just a digital entry on a banking app. It is 5 quarters from an era when American money still had real metal inside it. These aren't the modern sandwich of copper and nickel that feels light and cheap. These are silver coins, and that specific detail is the entire story. Because the moment you stop looking at the number stamped on the coin and start looking at what it's made of, you realize something uncomfortable. The price of money and the value of money are not the same thing. They have been drifting apart for decades. Here's the punchline that hits hard in 2025. If one of those silver quarters is worth around $14 in melt value today, then 5 of them are $1.25. At all, they were roughly $70. That means the modern metal-based equivalent of that 1960s minimum wage hour is not $1.25. It's closer to $70 per hour. And if you stretch that across a full day of work, you're staring at a number that doesn't feel like history anymore. It feels like an accusation. Around $560 for a day that used to be called a bare minimum. This is why silver makes people angry, and it's why silver makes institutions nervous. It turns everyday life into a math problem, and the math doesn't flatter the system. Welcome back to Veiled Wealth. Now take that perspective silver as a measuring stick for purchasing power and drop it into what's unfolding right now. Because today isn't a calm market day. Today is the kind of day where charts start looking like heart monitors and headlines start using words like surge, collapse, and ban in the same breath. Silver has stopped being a commodity people debate on social media. It has started acting like a stress test for the financial system. Silver ban begins, prices collapse, bank bailouts surge, and everyone asks the same question. Why is this happening? If you've been watching the tape, you've seen it already. Silver ripping higher, then getting slammed, then snapping back. It's not just volatility, it's violent repricing. One day, it's pressing into the 80s. The next, it's diving toward the 60s. And now you're watching it flirt under $70 like the market is trying to decide whether to break the floor or fake everyone out. And that's where most people get trapped. They think the story is the price on the screen. But here at Veiled Wealth, we warn you. The silver price flashing on your phone is not the same thing as silver in the real world. There's paper, silver leveraged contracts, ETFs, futures, promises, and then there's physical silver, the thing that actually exists, the thing you can hold, the thing that can be shipped, restricted, and hoarded. When a ban begins, when a major supply channel tightens, the difference between those two worlds becomes the whole game. When the headlines scream price collapse, most viewers assume demand is dead. But in markets like this, a collapse can mean something else. Forced selling, liquidations, margin calls, a cascade where the price is pushed down not because people suddenly hate silver, but because the structure around silver can't tolerate the volatility. This is the mechanism we are analyzing. When supply routes tighten or when a ban begins, the market doesn't politely adjust. It spikes, it snaps, it hunts liquidity. Traders scramble to reposition. Brokers raise margin to protect themselves. That forces weaker hands out. That pressure pushes prices down in a way that looks like a collapse, even as the underlying reality tightens. That tension screen price versus physical reality is where the most important signal hides. It gets why silver sits at the intersection of two worlds that don't behave the same way, finance and industry. It's traded like a financial instrument, but it's consumed like a strategic resource. When a ban begins, it hits both worlds at once. Lock this idea into your mind. Volatility is not a thesis breaker. Volatility is a structural revealer. When a market becomes this unstable, it's telling you something about leverage. It's telling you that the system can't handle honest price discovery without pain. That's why you're seeing surge and collapse in the same 24-hour cycle. The moment a ban enters the conversation, the market stops thinking in days and starts thinking in minutes. A silver ban doesn't arrive as a clean headline followed by a calm adjustment. It arrives as anticipation, leaks, and preemptive behavior. By the time most people hear the words silver ban begins, the market has already been wrestling with the idea for hours. Traders front-run the possibility, dealers reassess inventory risk, industrial buyers quietly secure supply, and leveraged players start sweating. This is where the market begins to fracture internally. The key idea is this. The ban doesn't just change supply today, it changes expectations about supply tomorrow. And because markets are forward-looking, they react instantly. Futures and leveraged instruments are the fastest to react. If margin requirements jump, positions get cut. That selling pressure drives prices down hard and fast. Meanwhile, physical silver moves slower. Suppliers hesitate. Dealers widen spreads. Buyers accelerate purchases. The result is a disconnect. The screen price falls because paper positions are being liquidated, while real-world metal becomes harder to source. This is the veiled wealth signal. Now, let's address the elephant in the room. As the flash crash plays out, another narrative surfaces. Bank bailouts surge, liquidity injections rise. This is where precision matters. This isn't necessarily a Hollywood-style rescue where institutions collapse overnight. It is a stress signal inside the plumbing of the financial system. When repo usage rises sharply, it means someone, somewhere, wants short-term cash immediately. Why? Because when markets become unstable, participants become defensive. They hoard liquidity. They reduce exposure. When liquidity tightens, leverage becomes expensive. And markets that rely on leverage, like silver futures, feel the pressure first. So saying bank bailout surge is dramatic, but the accurate framing is liquidity demand surges during stress. It tells you the system is tightening. It tells you that institutions are preparing for uncertainty, and that preparation has consequences across all markets, including silver. At this point, everything converges into the final question. Why silver? Why does this metal keep finding itself at the center of volatility, bans, and leverage stress? The answer is structural. Silver occupies a unique position where paper claims and physical reality are more loosely connected than almost anywhere else. On the paper side, price collapses because leverage is being purged. On the physical side, supply tightens. This creates the divergence. Silver is being pulled by structural demand that does not shut off easily. Electrification, energy transition, advanced computing, and data infrastructure all lean on silver's physical properties. Demand continues quietly and relentlessly underneath the financial chaos. This creates a structural deficit, and when a ban enters the picture, it acts like a stress test on the buffers that were hiding this deficit. So, what does the everyday investor actually do in an environment like this? Here is the veiled wealth perspective. First, do not confuse volatility with instruction. A collapsing price is not a command to sell, just as a spiking price is not permission to buy. Both are signals. In moments like this, clarity matters more than speed. Second, understand your role. If you're trading paper silver, risk management is your entire job. If you're holding physical assets for protection, reacting to intraday collapses makes no sense. You're not competing with algorithms. You're navigating a system that changes slowly underneath sudden shocks. And third, recognize what is actually at risk. Cash loses value quietly. Remember the $1.25 quarter. Debt compounds relentlessly. Financial systems protect themselves first. Bans, liquidity stress, and violent repricing are not isolated events. They are reminders of how fragile abstractions can be when physical limits are reached. History repeatedly shows that wealth and security accrue to those who outlast chaos, not those who try to dominate it. Outlasting chaos is less about bravery and more about discipline. If you understand what you have just witnessed, you don't need to panic and you don't need to be euphoric. You need to be deliberate. Ask better questions. Learn how the machinery works. Build resilience instead of chasing narratives. Because the people who make it through periods like this are not the ones who guessed right on a chart. They are the ones who understood the structure, respected the risks, and positioned themselves to endure while the system recalibrated around them. This is veiled wealth. Stay informed, stay prepared, and we'll see you on the other side.